Welcome to Walk Away Wealthy. I'm your host, Alan Terrell Gregory. If you're thinking of selling your existing business or looking to untangle yourself from your old business so you can start a new one, you came to the right place. Today, I have a very special guest, Rick Thomas. Welcome to the show, Rick. Tell us a little
Hey,
bit
Alan,
about
great to
yourself.
be here. Thank you.
Good.
Yeah, appreciate it. So, quick background. I like to say I'm a recovering engineer. I spent about 20 years in the plastics industry and manufacturing and ended up owning an injection molding company along with another guy for about 15 years of that journey. Ended up exiting right around 2005, and that launched a wild journey in the advisory business. So that's a quick background. My advisory business has had a few iterations since I started, but it's all been centered around working with the owner operator in the business and helping them develop a growth strategy that ultimately led to getting into exit planning, of which we can dive a little bit more into. There's a lot of different kind of inroads to that whole process, and I've attempted to travel as many of them as possible. I got my Series 65, so I'm an investment advisor. So I've certainly walked the road with the clients on the wealth management side of it. And as I mentioned, growth advisory and around strategic planning and developing the leadership of the executive teams and the clients I work with. And more recently, I've added to that in getting my certification in as an M&A advisor, because as the clients were beginning to exit and helping them prepare for that, the clients started asking me, can you help us actually sell the business? And it was just a natural adjacency to dive into that advisory business because I already had the relationship with the clients. I knew the businesses really well, and it just set us up well to help them, go to market or internal owner succession or whatever it may be. So that's kind of the quick snapshot overview of what I do.
Got it. So you said a lot there. So I want to unpack a couple things. So first, let's talk about your exit in 2005. How did that come about?
As I think about, it's interesting, as I think about what I help my clients with now, I was kind of laying the groundwork of what not to do in my own experience. I was woefully unprepared for that exit. There are a million questions I would have asked and decisions I would have made differently. But in essence, I had joined the manufacturing business. It was a family-run company, and I had joined as the only non-family shareholder in the business with the intent on being their succession plan.
Okay.
What ended up happening is, as I since learned, the cap table was a mess. And as one advisor, a mentor of mine, told me, he said, Rick, this is an omelet you're never going to unscramble. So I made one kind of last attempt to try to get them to budge and consider selling. They wouldn't. And so after my last try, I opened a factory, helped get a factory going in Suzhou, China. I exited the partnership.
Okay. So how did you come to be on the cap table? Like, let's go back a little bit further because you weren't initially. So how did you kind of weave yourself into that?
Yeah, it was kind of a sweat equity buy-in. He had approached me. So I was selling for General Electric at the time in their plastics division. And these guys were one of my clients and had a very good relationship with them. And he pretty much approached me one day and said, hey, we're interested in trying to get out of the business at some point. We'd really like to add you to the team, help us grow the business, and you can be part of that exit plan. So it was as simple as that.
Nice. Okay. So kind of like a consulting for equity play.
Exactly. And again, there's a million things I would have done differently, but it was with the intent on being able to eventually own the business. That was why I decided to move. I told him at the time, I said, look, I'm just not looking for another job. The next one I have is going to be involving some type of ownership. So that was the intent.
So how did that experience guide you toward becoming a CIPA?
Well, the SEPA came many years afterwards. I consider myself an accidental entrepreneur. When I got out of school, out of engineering school, I had no intent on being a business owner. That was the furthest thing from my mind. I was just interested in the engineering side of the business and, solving big problems, engineering problems. And I did that a lot. It's just through these circumstances that I ended up having this opportunity to be a shareholder in this business. The exit planning came, when was that? Probably 2013. So what is that, about 8 years later, when one of my clients wanted to sell her business to her son and daughter-in-law. Naturally, they came to us and said, who could you recommend that could help us with this? And I said, actually, we can. And so we just, kind of started this discovery process that ended up being fascinating experience in of itself. And it was really that event. We eventually helped him make the ownership transition. It took a little bit of a side road journey in that we part of our process is to do because they're in manufacturing, to do a supply chain risk assessment. And it turns out one of their key suppliers they were sole sourced with was going to retire. And so we went and did an audit and came back and said, you should buy this business. So that actually came before their ownership transition, as they acquired their primary supplier in the Southeast. The business is located here in Portland, Oregon. And that really kicked it off. And then we eventually helped them through that succession part in setting up the transition of the business to the son and daughter-in-law. And that's when it really kind of became a thing. Now, I didn't call it exit planning at the time. I had never heard of SEPA at the time. This is 2013. So we just began to message to our clients that, hey, if they're looking at monetizing their captured wealth at some point, that we have a way to help them with that. And that led to probably half a dozen different projects over between 2013 and 2020 when I ended up. So I was in a separate partnership at that time that I was doing it. I had joined a wealth management firm and I was doing a combination of my consulting and the wealth management at the same time. So as the clients would grow and then sell, we'd manage assets on the backside. So the model was working quite well, had gone through a number of exits, and then ended up departnering right before COVID. That's when I heard about the SEPA through the EPI.
Got it. So before we go that far, I'd like to learn a little bit more. So you said something about family businesses. It seems like you were involved in family businesses. So for the owners who are listening, can you take us through some of the exit options?
Yeah, sure. I mean, especially for a family business, probably at this point in kind of the maturity of the economy and as acquirers have kind of chased the market down into what we call the lower middle market, which is where most small to medium-sized businesses reside. Can
you define that in terms of revenue, lower middle market?
So, and I'll qualify this because it seems like if you talk to 20 different consultants, you're going to get 20 different answers.
Right.
As defined by the American M&A Alliance, it's between 5 million and 200 million in enterprise value. Okay. So pretty broad range on the lower end. And I'm sorry, I forgot your original question.
The original question was exit options. So before we even
so
get
the
to
exit options for a family held business certainly is the internal ownership transition. So if there is a second generation or maybe even a third generation that is working in the business, that is probably the least path of resistance, although it has its, family transitions have their challenges, no question. We could talk more about that, but that is certainly one that needs to be considered. Now, on the downside is if the founders really need to monetize their captured wealth in the business, and that is going to be a significant part of their wealth going forward, oftentimes that next generation, they don't have the money to buy the business. It could be perhaps some type of contract sale where they use the proceeds of the profitability of the business to help the next generation pay the founders. But sometimes that's not an option for founders because it's a lifestyle business, frankly. So they're pulling all the money out of the business, or a good chunk of the money out of the business, to support their lifestyle. And if that's the case, then it's typically going to market to some type of third party. Now, there are partial sales, recaps. Let's say if there's an opportunity for bringing in some significant funding to really scale the business. But if the founders are truly looking for exits, then it's a sale to a third party, and that third party could be anybody from a strategic buyer to a financial buyer, like a private equity, and now a growing population of buyers in the market are what are called search funders. And these are typically, smaller, on the lower end of the lower middle market. They're individual investors that, let's say, they've been backed with a certain amount of funding, and they'll look for a business to buy, and then they will be an operator. They'll take an active role in the daily operations of the business. So those are kind of there's some permutations in there, but those are kind of the three big categories, I would say, at this point.
Okay. So in terms of lower middle market, you talked about enterprise value. How does that break down to revenue or profits? You said 5 to 200 in enterprise value. What's that look like for revenue or profits?
Here's the consulting answer. It depends, because there's some financial gymnastics to get to that enterprise value. These aren't direct parallels, but the closest parallel would be, let's say, free cash flow. And a way to calculate that is a multiple of EBITDA.
Got it.
Okay. Typically, if the business is, let's say, under $1 million in enterprise value, typically what's looked at are what's called seller's discretionary earnings. It may even be a multiple of revenue at that point than EBITDA, because on a smaller scale of things. But for most of the lower middle market, it's going to be a multiple of EBITDA.
Got it. Okay. So what are some of the common challenges business owners face when thinking about exiting and or retiring?
It's a great question. And probably the number one that I will come across, especially for the original founder in the business, is this business has been so kind of intertwined with their identity, is beginning to think about the business as a separate from their identity as an owner. It's a very kind of emotional journey for the owners. That's a significant challenge. The other challenge is just from an operational point of view. A lot of owners are chief cook and bottle washer and bathroom cleaner, and you name it, right? So they haven't done the work to begin to replace themselves with professional management.
Right.
And these two issues are the most common ones that we help our clients begin to figure out, and develop planning on how do they raise the bar on the executive team or make key hires to begin to replace themselves. So they are replaceable. And
so what are some of the ways that owners can reduce owner dependence?
It's looking at the business from, where the key kind of roles in the business that are important to let's say have redundancy and handoff in the work that they do. So certainly operations, which is separate than the financial operations of the business, and then sales, customer service, and marketing. The last one that we recommend that the owners let go of is, especially if they have a key role in sales, is that role is to certainly begin to back themselves up. But the last thing there's so many other things to do that are frankly easier than to extract a founder out of the marketplace, because oftentimes those relationships are so important to the sustainability of that revenue going forward that we'll kind of slay that dragon last, but we deal with a lot of the other stuff. Right.
And the reason we want to do that is so that the business is transferable to a new owner. Is that right?
Absolutely. And this has a direct impact on valuation. They might be able to come up with a cocktail napkin valuation of multiple of EBITDA. Mm-hmm. But once a potential investor begins to look under the hood and realize, hey, I've got a huge amount of owner dependency here. The business is either at risk if something happens to them, or they get this big payday and they walk away. I need to account for that risk. So that's typically in the form of some kind of discount, or a larger share of that purchase price is going to be based on what's called seller equity. And that's the seller being willing to finance a good portion of the sale, certainly to get at a price that they want. But now that's going to be based on an earnout over several years for the owner to demonstrate, hey, the business can still run without me and I can hand it off.
Got it. Okay, so an earnout, is that also going to be considered a partial exit, or would that be a full exit?
Well, typically earnouts are partial exits. The owners are still going to be working in the business post-sale.
Okay.
Okay. I suppose there are instances where the owners are no longer employed. They may have a consulting agreement to be around to answer questions, but the key component of that payout is going to be based on the performance of the business. And if the owner is not in the business to have a direct impact on that, then that could pose a potential risk for the seller.
Okay. The reason I ask is because sometimes there's a way for people to get retained equity. So even though they sell the business, let's say they sell 90% of it, they keep 10% of it, so that as the new person comes in, they grow it, they get a second bite of the apple, so to speak.
Absolutely. And certainly in our current market with interest rates rising and whatnot, there's a lot more interest in those kind of deals, whether it's a larger component of seller's equity or retained equity for the proverbial second bite of the apple, certainly.
Got it. And yeah, I'm glad you mentioned the interest rates, because now that they are, 11% at the SBA, something like that?
Yeah.
Right. So the reason I say that is because at that high of a rate, that's exorbitant in my opinion, right? So in that case, you're usually looking at some more creative financing to get deals done. So that's why I asked.
Right.
Okay.
Right. Yep.
All right. So what kind of trends do you see that are favorable to business owners right now?
If a business is involved in infrastructure, develop any type of heavy construction infrastructure, while that's always going to have some volatility, the long-term trends in that are really favorable, especially in North America, for a whole host of reasons. There's a fair amount of reshoring, friendshoring, nearshoring happening. Geopolitical uncertainty has not only fed that, but there's also this general flight to safety, and that still is in North America. Even though many pundits had lauded Shanghai as being the new financial center of the world, or Dubai, and I would argue Dubai is probably more influential than Shanghai at this point, there's still a flight to safety to the US dollar. And that capital inflowing into North America, along with the reshoring and whatnot, anybody in kind of infrastructure development, that's a very favorable trend. Okay, so, heavy equipment, distribution services, any of that type of kind of heavy industry, B2B. Yeah.
All right. So I want to shift gears here a little bit. So how much time is needed to plan and execute a successful exit for a business owner?
A successful exit, the general answer is more time the better. I think trying to do something in under 3 years is a tall order. Now, this is going to be largely dependent on how prepared the business is for an exit, at the point at start. For a business that already has professional management and fairly robust processes around planning and sales development, market development, and growth, that could probably be done in 18 months to 2 years in helping the owners prepare for that, all things held equal. Conversely, if the owners are so entwined in the business that they literally touch every key function, that's going to take some time. And trying to do that in under a few years, I don't believe a business is going to maximize its full valuation potential in trying to do that quickly. Because I think the days of just ridiculous valuations and companies paying whatever the market asked, I think those days are gone for now. Not to say they couldn't come back, but I think we're on the waning side of the valuation curve, especially in the current market. Yeah,
exactly. Yep. So that brings me to my next question. What's the difference between your services and that of a business broker?
Yeah, it's a great question. So a business broker traditionally serves what they call Main Street USA. So if you go down to Main Street of any small town, you're going to see, hair salons, barbershops, restaurants, maybe a franchise business or two, a small hardware store. Those are the kind of businesses that business brokers tend to handle. Because it's brick and mortar. It also may involve some commercial real estate, but they act a lot like business brokers traditionally will act a lot like a commercial real estate broker, whereas they'll get a listing and they'll post a listing. Right. And you go to their website and there'll be multiple listings posted on business brokers. This is very different than how an M&A advisor will work. Because at least for me, I will only take one transaction at a time. That's all I have the capacity for. But I like to go in pretty deep with my clients on the growth advisory work. So I will have worked with the client for maybe several years before we get to the point of going to market. And then it's a very curated approach in the market where we will develop essentially a limited auction process for bringing that client to interested parties. And there's a fair amount of marketing.
Confidential, right?
Yeah, exactly. Exactly.
Okay. Good. Yeah. So it seems like what you're doing is you're doing the planning, then you're helping them with the actual, liquidity event. And then are you also doing any wealth management after the liquidity event? Like
we are. Yeah. For those clients that want to continue and leverage the relationship that we've developed, then we will manage the assets on the backside.
Nice. Okay. Yeah. So you know what? This is a question that I think a lot of people are going to be asking at this point. What does working with you look like?
Working with me looks like it's a deep dive. So it's not superficial. We have a lot of fun, but we will go in deep on the business and not only understanding the business, but understanding the motivations of the clients. And oftentimes, if somebody approaches us with the idea that they want to sell, we spend a lot of time really trying to understand why and getting beyond the financial answer to that question, but getting into kind of the emotional motivations for doing that. The brutal truth is that 80% of deals that go to market never sell.
Yep.
And it's because most of those clients they've never really done the deep work to understand why do they want to sell and what does that mean to preparation, as opposed to it's just something that, I feel like selling this year and why not? And without really understanding the tornado that they're just stepping into.
Yeah. So unfortunately, it seems like some business owners have been thinking about exiting or retiring for 3 to 5 years. And then they wake up one morning and say, hey, you know what? Now I'm going to list my business with a broker.
Right.
And that's not the way to do it.
It is a way to do it. It's not a way to do it to maximize the value in the business.
Absolutely. Absolutely.
Anybody can sell a business, right?
Right.
Anybody
Right.
can sell a business. Getting the full potential of what that business could mean in terms of manifested wealth, it's not a way to do it, certainly.
Right. So what characteristics do your best clients exhibit?
I want to go back to the name of my firm. It's First Generation Advisors, and I've named my firm after my clients that were most successful.
Okay.
And it doesn't mean that every client was the first generation in their firm. A lot of them were. Some of them are second and third generation, but it refers more to a mindset. That founding generation has a mindset. There's a sense of humility about the business and the hard work that it takes to truly build a business that is viable, sustainable, scalable, and ultimately sellable. Okay. This is a first generation mindset. And that's what I would say is for the best clients that we've worked with, they know this in their bones. And there's a sense about their stewardship of the business that even if it's a lifestyle business, that there's still a deep sense of humility about how hard it was to get to the business to a certain point and all that needs to be done to make sure that continues.
Great. So yeah, we're close to wrapping up here. So I want to ask you a few key questions here at the end. So what's your best advice for someone looking to sell their business or transition to a new one?
Get somebody in on the conversation. Don't do this alone. And this is even beyond just talking to a bunch of people, because the business owner is going to want to talk to somebody that's experienced in what this means. So certainly working with a SEPA is a great way to go. There's a lot of great SEPAs out there that can help them through that process, but they don't want to do this alone.
Got it. And what's one of your favorite quotes and why?
One of my favorite quotes is actually one that my mom would tell me. And it wasn't until I had a few years under my belt in the business to really understand the wisdom of this. She would say, sometimes you have to be who you're not to really know who you are. So I believe that being successful in business is as much as anything is understanding who you are as a business owner. What's your identity? Okay. That is as important as having those key clients, the right market, all that kind of stuff. We don't really get to learn about ourselves until frankly, we got to go out and make some mistakes. Somebody that has never failed in business is a mistake waiting to happen.
Agreed. Okay. And here's the last question here. So how can people get in touch with you?
Yeah, so the best way to find me, my website, firstgenadvisors.net. And then that's my email domain also. So rick@firstgenadvisors.net. Yeah, that's probably the best way to reach me.
Okay, sounds good. Rick, it was great having you. I appreciate you. Thank you so much.
Hey, Alan, really appreciate it. Have a great day.